Hey, it's Darius. Students have recently been telling me that they've been seeing simulations on the REG exam on estates and trusts, in particular, questions about transactions that happened shortly before a taxpayer died or maybe right after the taxpayer died. And the question on the exam is, what tax return do those items get reported on? So I decided to put a sim together that handles exactly that. So here at CPAExamtutoring.com, we take your thoughts and inputs very seriously. In fact, most of my new material is as a result of your request. So don't just subscribe to the YouTube channel, but actually go to CPAExamtutoring.com, click Ask Darius, send me an email, let me know what you would like to see as the next upload, or ask me any other question. I'll get back to you personally. So, upon the death of a taxpayer, a new tax-paying entity known as the taxpayer's estate is born, interesting choice of words, is born then to make sure no taxable income falls through the cracks. So somebody dies, right away a new tax-paying entity is created called the taxpayer's estate. Why? To make sure that the taxable income doesn't fall through the cracks. There's also deductions that are allowed maybe to be taken on this new entity, but the IRS doesn't really care so much about those deductions. They want to make sure that the income that the person was going to pick up doesn't fall through the cracks just because they died. So generally, this income is taxed either on the taxpayer's final 1040 or on the return of the beneficiary who acquires the right to receive the income. If that happens before the end of the year and somebody gets the asset, then they get the right to acquire that income. But if nobody gets the asset yet, then the asset stays in the estate, and then the income is taxed to the estate if they receive $600 or more of income. So this income is something that was earned maybe right before the taxpayer's death or maybe right after the taxpayer's death, and they're going to ask you which tax return does it appear on. The 1040, which is the final return of the taxpayer who died, or the 1041, which is the estate's income tax return. So the income's got to be picked up by somebody, and it is possible also that a beneficiary inherited the asset quickly, right away. So then the income might actually get picked up by that beneficiary, maybe the taxpayer's daughter or the taxpayer's spouse or the taxpayer's someone else. So we're going to look here. Jack, here's the facts. Jack's unmarried, was a self-employed consultant for the telecommunications industry in 2018 prior to his death. So that's what he did. He was self-employed in 2018. Before 2018, they tell us Jack worked as an employee for a large telecom company. So he worked all his life as an employee, then he went out on his own for a little while as an independent consultant, and then he died. Determine whether the following items should impact Jack's 2018 1040, Jack's estate income tax return in 2018, the 1041, or not impact either tax return. So we're going to keep it relatively, not going to say simple, but it's not going to be too terribly difficult. All we're going to do is choose between Jack's final 1040 or the estate's income tax return for 2018. So there won't be any asset that's inherited in 2018 by a third party. But we'll talk about it if it comes up in any of these questions. You ready? All right, so Jack's a calendar year cash basis taxpayer. What does cash basis mean? It's income when he receives it, deduction when he pays it, and he's a calendar year taxpayer, so just like everybody else, December 31st. Cash basis, just about everybody's cash basis. He died June 1st, 2018. So for all of these questions, just write down that his date of death was June 1st, 2018. And let's go to number one. Jack was entitled to receive a $3,200 consulting fee that had not been collected before the date of death. So he must have earned it, then he died before ever collecting it. And the executor of the estate collected the fee from Jack's client, look when? On July 2nd, after death, right? Death was June 1st. The fee was collected July 2nd, 2018. Now, where are we going to say that this income should be taxed? Now, we know Jack earned it before he died, but he never collected it. Died first. So this income has to be taxed. IRS insists that somebody pays the tax on this. Who's going to pay it? And the answer is it's going to get taxed on the 1041. Because as a calendar year taxpayer, he's not going to include the $3,200 in his final 1040 because it had not been received by the date of death. Even though it was earned, it wasn't received. He's a cash basis taxpayer. So the tax will be paid, but it'll be paid by the 1041. The estate that's created the day of his death will have income from June 1st all the way to the end of the year. That 1041 is going to pick up the income, whatever is received by the executor from the date of death all the way through to the end of the year. So this $3,200 would go right onto the 1041, the estate income tax return. And this would be ordinary income, earned income. So the classification of this income would be the same as it would have been if Jack would have lived to see it. It's ordinary income. All right, any questions so far as to why it didn't go on the 1040? Why did it go on the 1041? Number 2, on May 2nd, 2018, so that was before death. Remember, death was on June 1st. Jack completed a consulting job and sent a bill to the customer in the amount of $5,000. The customer was not satisfied with the work and indicated that he would only pay Jack $2,000. Jack agreed to reduce the bill to $2,400, but before payment was made, the customer died. The customer died on June 10th, 2018, a couple days after Jack died. The executor of Jack's estate could not collect from the customer's estate who died. How are you going to handle that? Is that going to go on the 1040 as some kind of a bad debt deduction, or is that going to go on the 1041 as a bad debt deduction? Because nothing's collected here. Earned but not collected for a cash basis taxpayer means no income, right? So the answer is nothing happens to this, no tax treatment at all. And that's one of the options. The options were either the 1040, the 1041, or no tax treatment at all. And that's how you'd handle this. Because failure to collect accounts receivable will result in a non-deductible loss. So yeah, it's a loss, but it's non-deductible. Can't do anything with it. As a cash basis taxpayer, this will result in no income for Jack on the final 1040, nor will it be income on the 1041. Yeah, he earned it, but he never collected it. And there's no deduction either because he's cash basis. Cash basis taxpayer doesn't get a bad debt deduction, right? The reason why there's no tax treatment here is because there was no cash collected. It wasn't collected before death. It wasn't collected after death. And the customer died 5 days after Jack did, so the executor never collected this either. And that's why there's no tax treatment. Just because you failed to collect accounts receivable doesn't mean you get a deduction, because a cash basis taxpayer never gets a bad debt deduction. Why? Because if you don't first pick it up as income, you can't get a bad debt deduction. Only an accrual basis taxpayer can ever get a bad debt deduction, and they test that on every exam in some way. So Jack had a life insurance policy in number 3 here that upon his death paid $1 million to his sister Kay. Now you know what happens when you get life insurance in a lump sum, there's no tax. So it's tax-free to Kay. There's no income there. So that's the answer. No tax treatment on the 1040 or the 1041 or on Kay's return. Life insurance is not taxable as income, so it would not be on any of these returns. However, if they ask you about the estate tax, the 706, not the 1041, but the asset tax, then that $1 million would be included in the 706 to value the estate of Jack to see if Jack's assets are greater than the 11 million-ish exemption amount. I'm not going to go over what the total 11 million whatever, because that goes up every year. So you just have to know that that life insurance policy would be included to measure Jack's estate for estate tax purposes, because if he had 10 million plus of other assets, that million might put him over the estate tax threshold, and he might have to fill out the 706 and pay some estate tax. But if this is the only asset he had, or not much else, then there would be no 706. And most people don't have the need for a 706 because they don't have 11 million plus in assets when they die. But as far as income goes in this question, there's no tax treatment on the income because that $1 million life insurance policy is not considered income. Not to Jack on the 1040, not to the 1041, and not to the recipient, the beneficiary. K wouldn't have any income there. All right, let's go to 4. In April of, so okay, now the only time you could have income in that is if there was if the insurance company paid you out over time with interest, then the interest would be income. But in one lump sum, life insurance is always tax-free. Let's go to 4. In April of 2000, number 4, in April of 2018, Jack incurred $13,000 of medical expenses. The executor of the estate paid the medical expenses on August 10th, 2018. Assume that the medical expenses are not claimed as a deduction on the estate return form 706. All right, what do we do with medical? Now, medical is a special treatment here because look what happened. Jack incurred the $13,000 of medical in April, shortly before death. Maybe he had a final illness. And he never paid those medical prior to death, but the executor paid it. So it would look like this would go on the 1041. It would look like that because any income received after death would certainly go on the 1041, not the 1040. The way medical works, though, is usually they would be claimed as a deduction on the estate return, Form 706. But if not, then they get claimed as a deduction on the 1040, never the 1041. Yeah, there has to be a waiver filed, exactly. So, although they were paid after death, the executor may elect to treat medical expenses paid by the estate for Jack's medical care as paid by Jack at the time medical services were provided. So this is a special provision that applies to medical. And they always test it on the exam because it's really a standalone provision. So although they were paid after death, the executor may elect to treat medical expenses paid by the estate for Jack's medical care as if Jack paid them when he left the doctor's office that day. Now, to qualify, the medical expenses must be paid within 1 year after the decedent's death, and they were. And the executor must attach that famous waiver stating that the medical expenses will not be taken on the Form 706. And since Jack's not going to have a 706 because his assets weren't, let's say, enough, then the choice is on the 1040 or the 706. We'll take it on the 1040. Notice the 1041 is not a choice. It's not an option for medical paid after death, even though it looks like it should be. Since Jack died during 2018 and the medical expenses were paid during 2018, medical expenses will be taken on Jack's final 1040. Deducting medical expenses on the 1041 is not an option. So you get to either deduct it on the 1040 if the waiver is attached or the 706, but not both. So number 5, Jack owned and operated a peach orchard. He sold and delivered 100 bushels of peaches to a canning factory for $4,000 in May of 2018, but did not receive payment before his death. So he should have got paid for this, earned it, never collected it. The executor of Jack's estate transferred the right to collect the payment to Jack's sister Kay. So there's no income in 2018 at all because nothing was received. Now, Kay eventually collected the $4,000 from the peach orchard or from the canning factory in 2019. So in 2019, this is going to be income to Kay on her return because she is the beneficiary here. She's the one who this right to receive this payment was transferred to her. So now she goes and collects it in 2019. That's next year. But the question's asking about 2018. So next year, this will be Kay's income. This year, it's nobody's income. It's not treated on the 1040 or the 1041. This is like almost like a bad debt at this point because no one's collected it yet. Now, this would have been on the 1041 if it were collected by Jack's executor sometime after the date of death. So let's say the $4,000 came in September, right? He died in June. So if the money came in September, it would go on the 1041 on some type of Schedule C because the 1041 has all the schedules that the 1040 has. So the 1041, if this were a business, maybe it would be a Schedule F for farms because this is like a peach orchard, so possibly it would be a Schedule F. The 1040 and the 1041 have the same subschedules, Schedule A, Schedule B, Schedule C. So whatever would go on the 1040 Schedule C would go on the 1041 Schedule C. So if this was collected in 2018, this would have gone on a Schedule C or a Schedule F. But because this was not collected in 2018, there's no treatment on the 1040 or the 1041. And when this is collected in 2019, Kay will put this on a Schedule C or a Schedule F. Schedule F is the farming income schedule. So in number 6, Jack sells a tractor on May 20th, 2018 for $3,000 that had a basis of $2,000. The $3,000 was payable July 8th, 2018, but Jack died on June 1st before receiving the payment. The $3,000 is received by the executor on July 8th, 2018. So this will go on to the 1041, but how much is income here? Not all $3,000, only the gain on the sale. The gain on the sale will go on the 1041, what they call income in respect of a decedent, anything that was earned maybe prior to death but collected after, that goes on the 1041, and nothing will appear on the 1040. Number 7, Jack was entitled to a $50,000 consulting fee at the date of his death. The amount was to be paid to Jack in 5 installments. He received the first installment of $10,000 February 8th, 2018, and the executor collected $10,000 September 1st, 2018. So there's $50,000 consulting fee out there. The first $10,000 he got before he died, right? The one in February that he got, that's going on as 1040 because he got it before he died. But the next installment was collected $10,000 September 1st. That was after death. That's going on the 1041, isn't it? So what was collected prior to death will go on the 1040. That's the first $10,000 received in February because he didn't die until June. So whatever he received in February is going to go on the 1040. That'll go on Schedule C, 1040. 1040 Schedule C for what was received in February. For what was received in September will go on Schedule C, Form 1041. The 1041 will have a Schedule C also, and that $10,000 from September will go on the 1041. So I could see them giving you that kind of thing all day long on the exam. And then the 3 remaining installments were transferred to Jack's sister Kay, but if nothing was collected this year other than the first $20,000, then Kay's not going to have any income until she gets that rest of it. And all it says is what happened in 2018. So there'd be nothing to Kay here, no income for her, because she didn't collect anything after that. So if she would have got something in October, November, or December, then maybe she would have income. But all we know about is that before he died, 10,000 is going on 1040. After death, 10,000 was collected. That's going on 1041. Now, what they could have done in this question is they could have said the right to the remaining 3 installments were transferred to Jack's sister Kay on November 1st, 2018. And on December 1st, 2018, K got a $10,000 collection. Well, then K would have $10,000 of income on her 1040 for that third installment, you see. But it doesn't say any of the remaining 3 installments were collected in 2018. But on the exam, they'll twist around, and they'll change things around. So look for that. If K gets an installment, once it transfers to her as owner, she now has the right to collect. If she gets an installment, then it's income for her. But it doesn't change the fact that the first installment received prior to death goes on the 1040. The one received right after death, before it went to K, goes on the 1041. And then now that K is in charge of it, if anything is collected in 2018, once she becomes the owner of this right to collect, because that's an asset too, that's a receivable now. Once she becomes the owner of it, if she collects it, it goes on her return. The remaining 3 installments are reported by K in the tax year received, whenever that is. And if she never receives it, there's no bad debt deduction because cash basis taxpayer. Number 8, Jack had previously been an employee for a large telecommunication company and received a check for unused vacation pay in the amount of $5,600. When did he get the check? May 11th, 2018, right before he died. And Jack had not cashed the check by the time of death on June 1st, 2018. But the executor cashed it on August 4th, 2018. Where's this $5,600 going to go? So he got the check before he died, but he never cashed it. Does that mean it goes on the 1041 because it was cashed after he died? No. Wages actually or constructively received prior to death are included on the final 1040. Because constructively, he could have cashed this check at any time. He got it May 11th. He could have cashed it any time between May 11th and the date of death. So this goes on the final 1040. Doesn't go on the 1041. Number 9, Jack incurred business expenses of $3,000 in May of 2018. Because remember, he owned his own business the last year of his life. So he had these business expenses, $3,000 in May, that had not been paid by the time of Jack's death on June 1st, 2018. The $3,000 was paid by the executor on July 8th. That's after death. So that goes on the 1041. Items such as business expense, interest paid, taxes, and income producing expenses for which the decedent was liable at death but were not paid before death, they're deducted on the 1041. So where's that going to go? Schedule C, Form 1041, Schedule C will have a business expense on it. All right, so number 10, Jack was a stockholder in Minder Binder Corp. Minder Binder Corp declared a dividend on April 18th, 2018 to stockholders of record who owned the stock on May 18, 2018, payable June 18, 2018. How do we handle this dividend? Any dividends declared before death but not received is income in respect to a decedent, which means it goes on the 1041. So you see how it was declared before death, but it wasn't received until after death? That means, like anything else, goes on the 1041. Because he could not have taken that dividend while he was still alive. It wasn't received yet. Number 11, Jack had an investment in Drummer Corp, a stock that paid a dividend to Jack of $900 on May 28, 2018. Jack had not cashed the dividend check at the time of death on June 1st, 2018, and the executor cashed the check on July 9th, 2018. And this is no different than the vacation pay that he got a check and never cashed it until after death. So this would be included in the final 1040 because it was actually or constructively received prior to death. Number 12, funeral expenses of $10,000 were paid by the executor on June 6, 2018. Well, unfortunately, that's an easy one. Funeral expenses are not deductible on the 1040 or the 1041. They would be on the 706 if there was an estate tax. 13, property taxes on Jack's home are due May 1st and November 1st. Jack paid the property taxes on his home on May 1st in the amount of $2,500. That was before he died. The executor paid the property taxes on Jack's home in the amount of $2,650 on November 1st because that was after death. So the $2,500 paid in May, that's going to go on the 1040 Schedule A. And the $2,650 paid in November, that's going to go on the 1041 Schedule A. So $2,500 is deductible on the final 1040, that was paid before death, but $2,650 is deductible on 1041 because it was paid after death. Any taxes of the decedent paid after the date of death are deducted on the 1041, but notice in this question, you're going to actually have taxes deducted in both places because $2,500 was paid before death, and that's probably the way you'll see it on the CPA exam. Because whatever was paid before death, that's going to go on the 1040. The same tax is paid after death, it's going to go on the 1041. On the same schedule, Schedule A, itemized deductions. Jack's executor paid off Jack's sports car. The remaining loan balance on December 5th, 2018 was $45,000. Interest on the loan was $5,200. Well, this is an easy one too because personal interest is not deductible on either Form 1040 or 1041. Because this interest is personal. It's not like home mortgage interest. So all you'd have to know here is that personal interest is not deductible, and you'd get that one right. Number 15. Jack has a $500,000 money market mutual fund on the date of death, June 1st, 2018. Total interest for the year ended December 31st was $3,000. So when the interest 1099 came in from the brokerage house, it said total interest for the year on this money market account, $3,000. The interest up to June 1st, up to date of death, was $1,480. Now, if you know that, then you know the interest up to date of death has to be reported on the final 1040. Schedule B, Form 1040, you'll pick up the $1,480. Well, the balance, the other $1,520, has to be reported on Form 1041, Schedule B. So it goes on the same schedule, just on the different return, because if not for death, it all would have been on the 1040 on Schedule B. So because of death, you have to divide it. What was the interest up to the date of death? That goes on the 1040. What's the interest from that date on? That's going to go on the 1041.